Three things stand out for me at the moment. The low interest rate environment and coping with the impacts of that. Secondly, conduct risk and the regulators' focus on that. And lastly, what is hopefully the finishing straight for Solvency II.
I think we're still got a lot more to see from what we call in cyber risk. It seems to me that you look at any class of business and you can have technology-related risks coming out of that. So, for example, I did a lot with the shipping industry, and there are a huge range of events that can be caused by cyber terrorism or just errors in software. So we see an instance where you can have collisions, fires and explosions, etc. So I think what we call cyber risk at the moment is probably, we'll be talking about this still in 12 months' time.
Today in the UK is the budget, and one of the key issues we certainly have in the UK at the moment is political risk. Actually, it's not something we've covered particularly here so far, but we write long-term insurance contracts. We might have liabilities that run out for 50 years, and we may invest in infrastructure, in long-term debt, and making sure that the political environment doesn't pose too much risk to our organisations is a very high theme at the moment. In the UK, we've seen huge changes in our pension regime, a sort of once-in-a-generation change in pension regime, so that's made us very kind of sensitive to political risk at the moment. And capital. We've talked a lot in the last couple of days about internal models, Solvency II. I see this afternoon the prospect of Solvency III and how quickly that will come. So, capital modelling and making sure that we're safe in the new environment.
Just regulations at the moment. Yeah, assets are just massively depressed, at least in fixed income. There's not much risk to be had. I mean, if anything, insurance companies are looking, as are every global investor at the moment, where they can deploy capital, basically. So not much going on the risk radar at the moment.
On the risk radar is the usual problems. What is the definition of risk-free? What are we doing with our books that have a profit participation? How are we dealing with annuities and guarantees? Also catastrophes to some extent for the reinsurers. I think the bigger challenges are around the way that we're dealing with emergent business risks, the way that we're creating value for our customers, the way that we differentiate the offering of an insurance firm versus an asset manager versus a saving account in an environment of low interest rates.
Well, everyone is now thinking about the low interest rate environment, in particular in life insurance, and I think that's a long-term risk which only starts to bite now, and that's something everyone needs to work on. Of course, it could turn out that after the end of quantitative easing that actually interest rates are rising, and that may create new risks. For instance, insurance products suddenly might become uncompetitive because returns on banking products are rising much faster than returns on life insurance products, and insurers face the risk of shrinking actually, or falling new business.